What if I told you that one of the biggest tax myths in America has convinced millions of people that buying something for their business makes it free? Short pause. You've probably heard someone say, just write it off. A new laptop? Write it off. A business trip? Write it off. A new camera? Write it off. But here's the problem. That's not how tax write-offs actually work. And believing that myth can cost you hundreds or even thousands of dollars.
Why this matters. Whether you're a small business owner, freelancer, side hustler, or just curious about how taxes work, understanding tax write-offs can help you make smarter financial decisions. At the same time, misunderstanding them can lead to expensive mistakes, unrealistic expectations, or even problems if you claim deductions you aren't entitled to. So today, we're going to break it all down using simple examples, everyday language, and real-world scenarios without confusing tax jargon. By the end of this video, you'll understand what a tax write-off really is, why it matters, and what it definitely is not. A real story. Imagine two friends. Jake and Sarah both decide to buy brand new laptops for $2,000. Jake runs a small graphic design business. Sarah buys hers mainly for watching movies, browsing the internet, and personal use. At the coffee shop, Jake smiles and says, "Don't worry, it's a tax write-off." Sarah laughs and says, "Great, mine will be free too." But when tax season arrives, Jake may be able to deduct some or all of the laptop's cost if it qualifies as an ordinary and necessary business expense, and he follows IRS rules. Sarah usually can't deduct the cost simply because she bought a laptop. Same purchase, same price. Completely different tax treatment. Now things get interesting. Why? Because a tax write-off isn't about what you buy. It's about why you bought it and whether tax law allows that expense to be deducted. What is a tax write-off? Let's make this as simple as possible. A tax write-off, also called a tax deduction, is an expense that can reduce the amount of income you're taxed on if it qualifies under tax law. Notice something important. It doesn't reduce the price of what you bought. It reduces your taxable income. Think of taxable income as the portion of your income the government uses to calculate your federal income tax. Here's an easy analogy. Imagine you're taking a math test. You start with 100 points. Before the teacher grades it, you're allowed to erase a few wrong answers that don't count against you anymore. Your score is calculated using the lower number of mistakes. That's similar to what a deduction does. It lowers the amount of income that's subject to tax. It doesn't erase the cost of the purchase itself. And here's what most people never realize. The actual tax savings depend on many factors, including your tax situation and the rules that apply. A $1,000 deduction does not automatically save you $1,000. For many people, the savings are only a fraction of that amount because deductions reduce taxable income, not taxes dollar for dollar. That's one of the biggest misconceptions about tax write-offs.
Tax deduction versus tax credit. Now here's another idea that confuses a lot of people. A tax deduction and a tax credit are not the same thing. Let's use simple numbers. Imagine your taxable income is $60,000. If you qualify for a $2,000 deduction, your taxable income may be reduced to $58,000 before your tax is calculated. But suppose you qualify for a $2,000 tax credit instead. A tax credit generally reduces the tax you owe directly, subject to the specific rules for that credit. That's why tax credits are often more valuable than deductions of the same dollar amount. Think about shopping. A deduction is like lowering the amount of items in your cart before the cashier calculates the total. A credit is more like getting a coupon that reduces the bill after it's already been calculated. Both can save money, They just work in different ways. What expenses can you actually write off? So, how does the IRS decide whether a business expense can qualify as a tax deduction? One of the key ideas is that the expense generally needs to be ordinary and necessary for your business. That sounds complicated, but it isn't. An ordinary expense is one that's common and accepted in your type of business. A necessary expense is one that's helpful and appropriate for running that business. It doesn't have to be absolutely essential. Let's look at a few examples. Imagine you own a photography business. Buying a professional camera, editing software, memory cards, or a computer used for your work could be business expenses if they meet IRS requirements. Now imagine buying a luxury watch simply because you think it makes you look successful. That usually isn't considered an ordinary and necessary business expense just because you own a business. See the difference? It's not about whether something is expensive. It's about whether it has a legitimate business purpose under the tax rules. Common business write-off examples. Many businesses may be able to deduct expenses such as office supplies, business software and subscriptions, advertising and marketing, professional education related to the business, business insurance, business travel that meets IRS requirements, a portion of internet or phone costs if they're used for business. Some businesses may also qualify for deductions related to a home office or business use of a vehicle, but those come with specific rules. That's why keeping good records is so important. Simply owning a receipt doesn't automatically make an expense deductible. You need documentation that shows the expense was for your business and met the applicable tax requirements. The biggest mistakes people make. Now, here's where many people get into trouble. One common mistake is mixing personal and business expenses. For example, if you take your family on vacation and spend one afternoon answering emails from the hotel, that doesn't automatically turn the entire trip into a business expense. Another mistake is assuming something's deductible because someone on social media said it was. You might hear claims like, write off your dog, write off all your groceries, write off your everyday clothes. Sometimes there are very specific situations where part of an expense may qualify. But those situations are usually much narrower than viral videos make them sound. Tax laws are detailed, and the facts matter. That's why it's always better to rely on IRS guidance or a qualified tax professional, rather than internet myths. Keeping good records is something successful business owners understand. Good bookkeeping isn't just about staying organized. It can save time, reduce stress during tax season, and help support your deductions if questions ever come up. That means keeping receipts, invoices, bank statements, credit card records, mileage logs when required, and notes explaining the business purpose of certain expenses. Think of your records as the story behind each deduction. The clearer the story, the easier it is to show why an expense belonged to your business. So, what's the biggest lesson from all of this? A tax write-off isn't free money. It doesn't mean the government pays for everything you buy. Instead, it's a legal way to reduce your taxable income when you have qualifying expenses under the tax rules. Understanding that difference can help you make smarter financial decisions, avoid costly mistakes, and run your business with more confidence. And remember, everyone's tax situation is different. This video is for educational purposes only. If you're making important tax decisions, it's a good idea to speak with a qualified tax professional. The more you understand how money works, the better decisions you can make, not just during tax season, but all year long. If today's lesson helped clear up the biggest myths about tax write-offs, give this video a like so more people can learn the facts instead of the fiction. And if you enjoy simple, practical explanations about business, taxes, banking, investing, and personal finance, be sure to subscribe to AN Time and turn on notifications so you don't miss our next lesson. Now, I'd love to hear from you. What's the biggest tax myth you've ever heard? Leave your answer in the comments. In our next video, we'll explain how LLC taxes actually work in the United States, and why choosing the wrong tax classification could cost a business more than expected. Until then, keep learning, keep asking questions, and keep building your financial knowledge.